Hi, and welcome to the Profit Playbook, the podcast aimed for business owners to help improve cash and reduce tax. Today's topic is all about remuneration planning and how to extract cash from your company. To help navigate this complicated area is my fellow business partner, Ed from Green & Co Accountants. So Ed, welcome to the show.
Thanks, Scott.
So just for the viewers, a lot of people won't understand what remuneration planning really is, or even what remuneration actually means. Can you just give us a little brief description as to what remuneration planning actually is?
See, a lot of people can't even say it.
Yeah, I know, I struggle to say it.
So remuneration planning is looking at how you take money out of your business. Now, lots of people hear remuneration and think of their salary. And that's just one way an owner can take money out of their company. So we advise most clients to take a small salary. And then the other ways would be dividends. It would be benefits in kind. It would be things like director's loan account interest. And there can be a number of other options as well for them.
That's great. So you've actually mentioned quite a few different things there in ways in which someone could take cash out of their business effectively. Do you mind if we break that down a little bit further and talk a little bit about each one?
Yeah, so salary is quite straightforward. Everyone understands salary. Yeah. And again, we'd normally explain to clients that the most tax efficient figure is $12,570, which is your personal allowance. Yep. You'll pay a little bit of employer's national insurance for the company, but not personally. Yep. So that works quite nicely. We can come back to that in a minute. Then we look at benefits in kind for clients. So sometimes they might want to change their vehicle. And there's some very tax efficient vehicles with electric vehicles. There's medical insurance that people these days are interested in with all the weights on NHS as well. And these are all ways that the company can pay these costs, but you get taxed on them as a benefit in kind. So it gets taxed like income tax, but without the national insurance. But the company pays the national insurance on the cost of those items. So that's another part where people can look at taking income from their business. Dividends is the main one, which most people take. That's the easiest one, but lots of clients don't understand how you calculate dividends. In terms of you have to take out the profits after corporation tax. Now, businesses are paying corporation tax at various rates depending on the size of their profits. And then whatever's left over, they can take their dividends from. And then they've got to pay personal tax on that at dividend tax rates, which are currently 8.75%, but that might be increasing in the future. And then there's the other one I mentioned, which is director's loan account interest. Which, again, if you've got a credit balance on your director's loan account, so the company owes you money because of money you've injected into the business, you can draw interest payments for the money that you've got invested in your business. And again, there's various rates you can use for that, depending on what your current bank balance is, how much the company needs the money. And therefore, if you go and try to get a loan from a bank, you might be paying 10, 11%. If you take credit cards, it could be 20, 25%. So there's a different rate you can charge the company for the money that you've lent to it, depending on how much it needs it. And that's a discussion with your accountant. But again, it's another very efficient way of taking money out of the business, because that interest that you charge is allowable for corporation tax. So it saves you money that side. And then individually, you pay income tax on it. But it's only at 20% if you're a basic rate taxpayer.
So you mentioned pensions as well, which is another option. Do you want to talk a little bit more about that?
Yeah, so pensions is another part of remuneration planning, although you don't get an immediate effect of it unless you're over 55, because you can't touch it until you're 55. So for a lot of clients, it's a long-term planning for remuneration. It's a very tax-efficient way of taking money out because you save corporation tax on the contribution the company makes. It's made as an employer contribution rather than an employee, so the company pays it on your behalf if you're a director. You get corporation tax relief on that. And then when you retire, you can take the money from the pension. So it could be a 25% tax-free lump sum, which we still have, but it's not called tax-free lump sum anymore. Yeah. It's just a tax-free element. And then you draw it out as and when you need it. So that's very good for long-term planning. But like I say, you can't touch it very early. And lots of my clients will use it for things like buying commercial property or even looking at investing the money themselves, some of them, because they're so keen on the stock market.
So there are other forms of remuneration planning that I've heard as well. Things like trivial benefits, the £50 gift vouchers, use of home as office. Do you want to talk a little bit more about those?
Yeah, so they wouldn't be part of your income tax return. So that's why I didn't mention them earlier. But yes, there are other ways you can extract money from your business. and very tax efficiently. So use of home as office, the government thinks it's quite cheap to run your office at home, so they give you £6 a week to help you cover your costs. I know, isn't it good? And that would be a cost in the business that's allowable for your corporation tax, and you can get paid that with no personal tax on it. The other one you mentioned was trivial benefits. One of those is gift vouchers, and you can give those to your staff, as many as you want, £50 up to a maximum of £50 a time. It has to not be transferable for cash, so it has to be something you pay for in a store somewhere. But you as a director can actually have that 6 times a year. So that's £300.
And there's a cap on that, right?
There's a cap of a maximum of 6.
Yeah.
But if you're husband and wife, both directors, that's doubled up to £600. But you need to have it at £50 a time at 6 different times during the year. And they both work quite nicely.
That's great. What about another option of renting a premises that you might own, or commercial premises outside of the company, for instance, back to the company?
Yes, I've had several clients who own their own premises, like you say, and they owned it historically before they become limited companies. And yes, it can be a very tax efficient way for them to charge rent on their units to the business. And again, the company would get relief for the cost of that in their company accounts and reduce their corporation tax. Personally, then, they'd have income tax, but it's only at 20%, no national insurance. So it's a very efficient way to recharge that and take money out of the business. You would need to get a realistic rate of market value for the rent, and you don't need to have a lease, but your bank might want you to have a lease if you've got a mortgage on it.
Are there any issues around valuations? Do we need to get like a RICS valuation, an estate agent involved, or anything like that?
Ideally, you would ask a friendly estate agent who deals with commercial property, so you've got a realistic figure for what the market value is. You can look online and compare to other buildings. If you've got something that's comparable, keep a copy of it and use it. HMRC would be happy with that.
So, Ed, it sounds like quite an important area for most businesses and something they should really be aware of. Do you often find that clients or new clients that are coming to the firm are aware of this sort of issue?
Very good question. Very good point. Yes, it's very important to look at how you take money out of the business because you can save an awful lot of tax. Sadly, most new clients we come across haven't had that experience. I don't know why, but a lot of accountants out there aren't explaining this to clients and giving them all the options that they could use. So one thing we do with all our clients when they come on board is talk about how they're going to take money out of their business and how much money they need to live on. Can the business afford that? And then looking at the most tax efficient way of achieving that. But we look very holistically at the client. So it might be a case that they're thinking of changing their car in the next couple of years. So we might be saying, well, okay, have you looked at company cars and looking at electric cars or hybrid cars as various options in the remuneration planning? Because whatever we can get the company to pay for rather than the individual pay for is more tax efficient. And so every single client, we do that process.
Absolutely. And as you said, it's a very holistic approach, isn't it? So it's not just looking at the company, but it's looking at the individual as well. They might have various aspects of other income from all other sources. So that all needs to be taken into account in the remuneration planning as well.
Yeah, they could have rental property, which might push them into higher rates. So actually you might want to take less. You might have one spouse who's earning more than the other. So you might want to split the shares differently. And you can have different shares and you can give shares between husband and wife with no tax consequences.
So Ed, there's a lot of things to think about when it comes to remuneration planning, as we've already discussed. What are the first things you tend to look at with a client, and do you have any examples of that?
So with all clients, I have an aim for them to take £50,000 up to the basic rate threshold, which is actually £50,270. But historically, you edged into the child benefit, whereas now that's gone up to £60,000, so that's okay. If you've got a husband and wife taking £50,270 each, you've got £100,540 going to that household, which is a nice amount of money. So we start by taking the salary, £12,570 each. That's a nice, easy starting point. We then look at benefits in kind. Did they want to have company cars in? Didn't they? Did they want medical insurance, golf membership? Lots of different things that the company could pay for on their behalf, which is very tax efficient. And then once we decide how much they want in benefits in kind, we see if they've got any director's loan account interest that we could be charging. Lots of clients haven't got that, so that's only an option for some people. And then we start looking at things like dividends being the main other option. So if you've got a client who's got 12,570 in wage and then the balance in dividends, then that can be as simple as that. And if you've got just that scenario, the income tax would be about £4,000 for each person, just under. So £8,000 in total for the couple. So you've got £92,500 of cash in your pocket after tax. And that's quite nice. But obviously you've already paid corporation tax on it. And you also have to have a business that's making enough profit in order to pay all that out.
If you had a client who actually said, I need to take more cash out of the business, I need more to fund my lifestyle, I need to go over the 50k, Ed.
Yeah,
basically.
we do have them.
Yeah. What advice would you give to those individuals?
Again, you sit down and look at the options. Dividends and salary are getting closer and closer in terms of taxes. And if you're looking to get into high rate tax, and the companies are quite a large company, paying tax either 26.5% or 25% at the moment, you might actually be looking at switching it back to salary. It just depends on all the variables.
Yeah.
So there's not one option that fits all. If it is just dividends, then they're going to lose a third in tax of the balance between 50 and 100k. If they've got kids, they're going to lose child benefit between 60 and 80k. Yeah. So there's lots of things to think about. Don't go over 100,000, because if you do that, then you start losing your personal allowance. And that makes the tax a lot higher, more like 50-odd%. So it's all these different options that we have to discuss and see which is best for the client and what they're trying to achieve. Some clients don't want to take the money out now. They'll build up a loan that they owe the company. And then in a few years' time, they've got a plan either to sell the business or there's something big going to happen. And therefore, they do it that way. And they have a loan from the company instead. And they'd have a benefit in kind each year of having a loan. And they have to pay something called Section 455, which is a bond to HMRC.
Okay.
Which we can talk about on another show.
Yeah.
So there's lots of options and lots of things they can and can't do.
Yeah. So lots to think about clearly. And as you just said, there's never a one size fits all. So definitely good for people to get out there and start talking to their accountants about this area.
Yeah, get advice, talk to your accountant, and then you can make a clear decision.
That's brilliant. Ed, thanks very much for being on the show and valuable insights as always. Thank you. So if you'd like to know a little bit more about remuneration planning, please download our free ebook below. And if you have a topic that you'd like us to discuss in the future episodes, just let us know in the comments below. Thanks again for watching, and don't forget to like, share, and subscribe.